folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you with a brief market update, kind of let you know what's going on. If you looked at the financial news over the past couple of days, you'll see the term relief rally, which is something we're going to come back to in a little bit. The S&P 500 for a level is right around 4,500. That's off plus or minus about 5% for the year. So we've clawed back about 5% of the losses. It's been an interesting market over the past, sort of week and a half. We had Powell come out earlier this week and sort of talk about inflation and how it is, gotten a little bit out of control, and that the Fed will move aggressively to sort of curtail it. Normally this would be viewed, I think, as a negative, but the market has taken this and rallied a little bit off the back of it, which I think is an indication that the market shares the Fed's concern about inflation and is excited to actually see the Fed moving in, quote unquote, the right direction to raise interest rates. In fact, the market's pricing in about 7 interest rate hikes this year based on forward yield curves. Which is interesting because there are only 6 more meetings left. So it prices in, at least at one of those meetings, that they would do a 50 basis point hike as opposed to a 25 basis point hike. And the market's rallying off that news, which I think once again comes back to the market's concerned about inflation. And so the Fed raising interest rates is not actually seen as a bad thing. It's seen as a positive. With that, we start to get a little bit of commentary around the yield curve. So for those of you who are watching these videos a couple years back, you'll know that the yield curve looks at the various yields of government instruments at different durations. So like a 2-year versus a 5-year treasury versus a 10-year treasury. And it sort of compares those. And at some point, the yield curve can get inverted, which is where you would actually earn more interest on a 2-year bond than you would on a 10-year bond, at least over the years that you held it. It's worth noting that, in the past, there's been a lot of commentary about how this is a reliable predictor of recessionary activity. We've recorded on this in the past, and I won't, waste a whole lot of airtime on this, but I would just note that, today's market is pretty different than prior market forecasts. An inverted yield curve, if and when it happens, could be an indicator that people really value safety up close and aren't worried about it later on. It also could be an indicator that people think that we've got, an inflationary problem in the short term that we're going to fix later on. So if you think that inflation is really a 1 or a 2-year issue, not a 10-year issue, then you can pretty easily paint yourself a picture where you should get paid more for 2-year treasuries than you should for 10-year treasuries. I'd also just note that this is one of the most manipulated yield curves in history. So anytime that I start to see economic indicators or market indicators and talk about, whether or not those are actually predictive or not, you have to kind of look at, well, if it was predictive in the past, is it the same indicator that it was, is it today the same indicator that it was in the past? In the case of the yield curve, with all of the various quantitative easing and the Fed buying assets onto its balance sheet, as well as just manipulating interest rates on the front end, I would answer no. This is a wildly different beast than we had in the 70s and 80s and 90s, and even the early 2000s, which is when most of that stuff was written. So, as always, with that, I hope you're having a great week. If you have any questions for me or for your advisor, please just reach out, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.